Before we go any further, make sure you subscribe to this channel now, because the lessons I'm about to share can save you years of unnecessary losses. What I'm going to tell you isn't theory, and it isn't the hollow optimism that fills most trading rooms today. These are lessons carved out of real battles with the market, paid for in money, in stress, and in experience. And if you use them wisely, they'll shorten your learning curve more than any indicator ever will. The truth is this: most traders chase complexity because it distracts them from confronting their own weaknesses. They look for holy grails, magic indicators, or some secret the professionals are hiding. But the market has never rewarded complexity. It rewards discipline, structure, and a clear understanding of how human behavior repeats itself in cycles. And that's precisely where the Fibonacci strategy finds its power, not in mysticism, but in the predictable patterns of human emotion. When I look at the market, I don't see numbers on a screen. I see fear, greed, hope, denial, conviction, and exhaustion. I see the emotions of thousands of traders translated into price movement. The reason Fibonacci ratios matter isn't because the universe is speaking some divine mathematical language. They matter because human behavior is remarkably consistent, and price retraces in the same proportions because people react in the same proportions. What we call Fibonacci is simply the footprint of crowd psychology. Before you think of trading Fibonacci like a textbook student, you need to understand that price isn't reacting to lines. Price reacts to the decisions of traders who are influenced by emotion. Those ratios, the 38.2%, the 50%, the 61.8%, they represent points where the majority rush back in, convinced they're getting a bargain, or where the hesitant finally give up and fold. The market repeats these moves because people repeat their reactions. When you look at a chart and draw Fibonacci levels on a swing move, you're not drawing magic. You're drawing the likely emotional spots where traders will step back into the fight. And if you learn to read it correctly, you'll see exactly where demand strengthens, where supply dries up, and where the trapdoors sit waiting for those who jump in too early or too late. But before you can even consider applying Fibonacci strategy in your trading, you need structure. You need rules so solid they don't shake when the market shakes you. Fibonacci is a tool, but without discipline behind it, it becomes a crutch for traders who are looking for permission to enter a trade, and that will ruin you faster than any losing streak. Here's the first truth about Fibonacci strategy that most traders never learn. It is not an entry system. It is a framework for understanding where price is likely to breathe. A trend is like a tide. It moves, it pulls back, it gathers strength, and then it breaks forward again. Those retracements, shallow, medium, deep, they reveal how strong or weak the underlying trend actually is. The ratios aren't predictions, they're measurements of the crowd's conviction. A shallow retracement tells you traders are eager, almost too eager, to keep the move alive. A deeper retracement tells you the market is uncertain, searching for confidence. And when price blasts through all the retracement levels without hesitation, that's the market telling you the story has changed and your assumptions need to be thrown out immediately. Never marry a bias, never cling to a trade, and never argue with the market. I've done all three in my earlier years, and every time I paid for it. Not because I lacked intelligence or skill, but because I allowed emotion to cloud judgment. And that's the danger most traders bring into Fibonacci strategy. They draw their lines, and then they begin to hope. They want price to respect the level because they already decided to take the trade. They want the level to be important because they're tired of waiting for opportunities. And hope is the most expensive emotion in the trading world. Your job is not to predict. Your job is to observe. Price will always tell you the truth if you're willing to listen. When you're working with Fibonacci, you begin with one question. Is the market trending? If the answer is no, you do not use Fibonacci retracements. You walk away. Because applying Fibonacci to a choppy, directionless market is like trying to read a compass underwater. Everything becomes distorted. You need a clear directional swing, a leg that shows conviction, momentum, and intent. Without that, the levels mean absolutely nothing. Once you identify a strong impulse move, you wait for the retracement. This is where the majority of traders fail. They see the impulse and jump in, afraid to miss the move. They assume momentum is eternal. They think the market will run forever in a straight line, but nothing in the market moves straight for long. Every trend takes a breath, and the breath is where Fibonacci becomes valuable. You draw from the start of the swing to the end of the swing. Now you watch the levels. Not all levels are equal, and not all are relevant in every environment. The 38.2% level often represents a strong trend, one where traders are too eager to wait for a deeper discount. The 50% level, while not a true Fibonacci ratio, is where many institutional traders step in, because gamblers and impatient traders are often shaken out right around that midpoint. And then there's the 61.8% level, the golden ratio, as people like to call it. This is where the battle is most intense. When price approaches 61.8%, it is testing the trend's integrity. A strong trend will often defend this level fiercely. A weak trend will crumble right through it. But again, none of this matters if you can't control yourself. I've watched traders destroy perfectly valid strategies because they could not wait for confirmation. They see price approach a Fibonacci level and enter before price shows any sign of reversal. They buy simply because the line is there, and when the market continues to slide, they blame the strategy. But it wasn't the strategy, it was their impatience. Here's a rule that will save you a lifetime of losses. The level is not the signal. The reaction at the level is the signal. When price approaches a Fibonacci zone, you wait. You think of it like watching a battlefield. You observe who steps in, buyers or sellers. You watch the candle bodies, the wicks, the momentum. You look for compression, absorption, rejection. You watch for the shift in control. Only then do you act, not before. Patience is what separates a disciplined trader from a desperate one. And make no mistake, the majority of traders are desperate. Desperate to recover losses, desperate to prove themselves, desperate to catch every move. And desperation is a disease in this business. It clouds the mind, corrupts decision-making, and blinds you to the obvious. The Fibonacci strategy works best when used as part of a complete understanding of market structure. The retracement gives you context, but the structure gives you clarity. Are you retracing into an area of demand? Are you retracing into a previous break, a former high, a liquidity pool, or a freshly formed imbalance? When Fibonacci aligns with real structural context, that's when it becomes powerful. When you rely on it blindly, it becomes dangerous. Let me tell you from experience, every significant fortune I made came from aligning multiple points of confluence, never from relying on a single tool. The market doesn't reward isolation. It rewards confirmation. And if Fibonacci is showing you a level but the structure disagrees, you step aside. But if the structure aligns previous demand, clear trend, controlled pullback, and Fibonacci levels converge on the same area, then you're looking at an opportunity with weight behind it. Yet even with this knowledge, you need risk management stronger than steel, because no matter how confident you feel, the market owes you nothing. You can be right in analysis and still lose. You can be wrong and still win. The market is not a moral judge. It is not here to validate you or punish you. It simply moves according to the balance of orders. That's why you never risk more than you can withstand emotionally. You never widen your stop. You never chase. And you never increase your position size because you feel certain. Certainty is the most dangerous emotion you can bring into a trade. Fibonacci strategy requires clarity. If you cannot remain objective, then no strategy will save you. You need to detach yourself from the outcome. You need to view every trade as one of thousands you will take over your lifetime. You need to protect your capital with the same intensity you would protect your breath underwater. Because losing capital is not the real danger, losing emotional control is. When you combine Fibonacci retracements with patience, structure, confirmation, and disciplined risk management, it becomes a powerful strategy. But when you combine it with impulsiveness, hope, and fear, it becomes a trap. The difference is always you, not the tool. I've seen traders who mastered the Fibonacci technique and built consistent careers with it, and I've seen others use the same strategy and blow up account after account. The difference wasn't intelligence. It wasn't skill. It was discipline. The market tests your character far more than it tests your knowledge. It punishes ignorance, but it absolutely destroys arrogance. The moment you feel certain, the moment you feel untouchable, the moment you believe you've outsmarted the market, that's when the market reminds you just how small you are. Fibonacci retracement is not a shortcut to profits. It's a mirror that reflects the rhythm of the market. And the rhythm of the market is the rhythm of human nature. If you follow it with patience, clarity, and discipline, you will eventually find consistency. If you fight it, ignore it, or force it, you will eventually find ruin. Most traders will hear these words and still do the opposite. They will rush, they will guess, they will overtrade. But if you're still listening right now, then maybe you're part of the rare few willing to do the opposite of the crowd. Maybe you're willing to be patient, to be disciplined, to follow structure, to trade with intention instead of emotion. The Fibonacci strategy will reward you if you respect it, and it will punish you if you try to bend it to your emotional needs. The market doesn't care what you want, but it will reveal exactly what you are: disciplined or impulsive, patient or desperate, structured or chaotic. Your job is to choose which trader you will be. And if you want more lessons like this, lessons rooted in discipline, structure, and real trading experience, subscribe now. Because the only traders who survive in this business are the ones who keep learning, keep refining, and keep their emotions in check. The tools matter, but the mindset matters more. And if you can master both, you'll put yourself in a class of traders the majority will never reach.